I am Dr. Sanjeeb Pattnaik. I welcome all of you to this particular session that we will be undertaking today for the next 1 hour or so. Uh, we are into a particular course which is equity markets, and it has been coded as MMPF 007. Now, already in the block 1, we have seen the basics of equity markets. In the first two units that we had in block 1, we have seen the basics. Now, today we shall be going into block 2, where we shall be dealing first with something called as the primary market. And in primary market, the first thing we shall try to see is what are the various avenues or sources that are available to various organizations, and the way in which, that means in other words, the methods they can raise capital for their needs. So let us go into the subject. Organizations require funds or capital. Now, if you look around, big organizations are always in need of huge funds or capital. Now, when we take fund directly, it is all right. Suppose we take machinery, etc., that also forms a part of the funds. Now, both of them combined together, or in simple terms, we call it as the capital invested in an organization. Now, why do organizations require funds or capital? Let us take our example. Why do we require funds or capital? Suppose we are having a business of our own. I am a businessman. Suppose my business is growing day by day. What will be happening? I will be in requirement of more capital so that I can invest in more goods that I can transact, and I can generate higher income as compared to today. So requirement of organization is similar also. When they have uh, plans like modernization, diversification, expansion, etc., that means they are enlarging their businesses either in the same business or in some distinct business which are new to them, but they have already succeeded in the previous years. They require further capital. Or even if to set up the organization, one needs the capital. Now, what are the various avenues from where we can get capital? In general, we can say an organization can uh, have the sources of fund or avenues of fund as the internal sources and external sources. Now, when we say external sources, we try to say certain words. As we shall move on, we shall try to see that it is equity and debt. Now, when we are talking about equity, it is nothing but the owner's funds or the owner's capital. That means the capital invested in the organization, which belong to the investors who are called as owners. We shall see why they are called as owners. Now, debt funds, yes, we can get loans, advances from various financial institutions, banks, etc., whereby we have to pay a certain kind of interest on a regular basis to them until the full amount is repaid back. So those are debt sources. Now, what are the internal sources? Now we say retained earnings. Name itself, retained earnings. First of all, what are earnings? Now, during a given period of time, we say the earnings are nothing but how much we have expended in producing the goods and what is the gap with the revenue. Revenue means the income. So, income minus expenses will give us the earnings. Now, out of those earnings, instead of using it totally for our own needs, we try to keep it for future requirement of capital by the organization. So that we say retained earnings. That means the portion of earnings which we have held back from the previous years so that we can meet the future requirement of capital. Now, what is that capital? As we have just now discussed, capital is nothing but whatever is invested in the organization, maybe in the form of money or the assets. So, wealth invested in an organization, whether be it in monetary form or in terms of assets like land and building, machinery, etc., those together, taken together, form the capital. Now, what are the objective of raising funds? Why do we require funds as a organization? Now, we can say in order to meet the future demands, we need certain kind of future aspirations of the organization. Aspirations like we shall expand our existing structure, we can diversify to other products and use our brand name. We can also modernize the thing so that the cost of production comes down. So this will make what? Now additional income will be generated. So the primary objective of raising fund is generation of additional income. So in order to generate additional income, the operations, that means the processing part of an organization should run efficiently to make a positive contribution to the economy. We shall produce goods and services which are of the set standards or required quality. Now, when we say capital, the capital as we saw just now, it can be in the form of equity or loans or debts or also working capital. Now, what is working capital? It is nothing but the capital invested in an organization to meet the day-to-day operations. Suppose running the plant, it requires raw material, labor, etc. They form a part of the working capital. But when you think about, suppose a machine X is there. What is it doing? Now we keep using for a number of years. Some machines may be operating for years gone by or years to come. So those are long-term assets or long-term investment of funds or capital. But when we are talking of working capital, whatever is the requirement on a day-to-day basis, that we are calling as working capital. So the capital that helps for day-to-day operations, that is working capital, and the equity or loans, they help in expansion, modernization, diversification, etc., or for the overall development of the organization. So, as we have seen, the need for the capital are usually for the expansion, that means enlarging our operation, that means volume of operation. Diversification, that means foraying or going into products that we are already producing, but some certain other new products which are not a part of our existing production line, or we can go for modern technologies, etc., so that it can reduce the cost of production, like modernization. Nowadays, automation, robotics, etc., or AI are coming into the picture, which are leading the organizations to a vast reduction in the cost of production. Thereby, the surplus income or the profit portion is happening. Now, let us see what are the place from where we can generate the money. We are talking about today is primary market. Now, when we say primary market, what is it? Primary, the basic market. It is nothing but the market for issue of new instruments or financial claims. So it is also called as new issue market. This market facilitates generation of fresh capital by issuing securities like equities, preference shares, debentures, government securities, corporate bonds, etc. Now, when an organization requires fund, it can tap the investors' surplus amount through securities. So, this is done or facilitated by the primary market. Funds are also mobilized by central and state governments, public sector units, banks, financial institutions, private sector also. And the securities or the equity shares are also classified as public, rights issue, bonus issue, and private placement. As we go on, we shall try to look into that. So, what are the various issues that we see in the primary market? Now, we are talking about equities, equity share. First is public issue. Public issue can be of two types: initial public offer and further public offer. What happens when a company, suppose, is requiring rupees 100 to be set up, or for certain kind of expansion project it requires rupees 100. So what it will do? It will try to tap the investor's surplus amount, or it will go into the primary market. Either it can take in the loan forms or in the equity shares form. Now, who are the equity shareholders? Now, the owners of the company. Why generally we call them as owners? Because they are those kind of investors who participate or stand by the company in times of profit as well as losses also. So, when equity shares are received in the market for the first time to the public, it is called as initial public offer. Sometimes what happens, due to the company's background or the promoter's background or the track record in other field if it is operating, people have lot of faith on the company. After the initial public offer is over, if the demand is very huge, companies can also go for further public offer. That means a portion of their equity share capital base is further offered to the general public. Second, rights issue. Suppose a company has 100 number of equity shares. I am holding 10 equity shares of that. That means I am 1/10 owner of the company. My investment forms 1/10 of the company's equity capital base. Now, suppose the company goes for any kind of fresh issue of equity shares for raising capital. First, it will take care of its existing shareholders like me. Suppose the company wants to issue further 50 shares in the market. Now, out of these 50 shares, I have the privilege of taking up the shares as per the proportion of shares I am holding in the previous structure. That means 1/10. So I am eligible to have 5 equity shares. That means 1/10 of 50 is 5 equity shares. And the price of the shares are usually lower as compared to the market price. This is done so that the existing shareholder do not feel dissatisfied regarding their holding in the company. Next, bonus issue. Now the company suppose has uh, huge amount of reserves. Reserves in the sense the retained earnings out of the previous profits. So it may issue equity capital to the existing shareholders in certain proportion, usually according to the holdings by the existing shareholders, but it is free. The reserves which are ultimately belonging to the existing equity shareholders, they will be offered as free gifts, freebies to the existing shareholders, called as bonus issue. Another issue type in the primary market is private placement. The name itself, private placement, that means instead of going to public in general, we do it in private. That means in our own convenience. There can be two ways. One is preferential issue, second is qualified institutional placement. Now, what is preferential issue? Now, if the company wants to have funds, raise funds through equity shares, it will try to select certain organizations, few organizations who will take up their equity shares, like big financial institutions, mutual funds, etc. That means we give them preference in the issue that you take up the shares first. Similarly, we also have qualified institutional placement. We have a list of institutions who can absorb or take up our shares. So they are called as qualified institutional units, and there we can place our equity shares. Now, what are the various characteristics of primary market? Now, the first is allocation of resources between companies and investors. Now, who become investors? Think about a person whose income is 100 rupees, but his spending every month is 60 rupees. So, after taking away or giving all the expenses, he is still left with 40 rupees. Either he will be or she will be depositing in a particular financial institute like banks, etc., or he or she can go for direct investment. So those are surplus investors or surplus entities. Now similarly, when huge number of surplus investors, that means small investors come together, then the amount of fund that is pulled up becomes too big. And these funds are usually channelized to companies either having a track record or having a better future prospect. Like nowadays, we look at companies which are working on AI or on renewable sources of energy. So, resources are channelized from surplus investors to the needy companies who are deserving it is the primary characteristics of the primary market. Now, this thing has to be regulated because chances of uh, malpractices, frauds, unethical practices can happen in the marketplace. In order to check this off, we should have a regulatory mechanism. In India, we have SEBI, Securities and Exchange Board of India, who try to safeguard the interest of the investors through various regulations. Now, when the company issues securities in the marketplace, suppose two companies are issuing their securities, X and Y. X is having a very good track record, Y is having a not so good track record. So, we as an investor, let us think which company we shall invest, X or Y. Immediately, all of us would say, no, we shall try to invest in X. So, X company shares, the demand increases, thereby dragging the price upwards. So, we say the reverse is also applicable. In company Y, there will be less demand, so the prices will be falling. So, this balance in the marketplace, according to the organization, investor create the demand, thereby create the prices. So, we say existence of price for the securities issued. In the marketplace, usually who are operating? As we have seen from these various aspects, nobody but investors and various institutes, companies. What are the factors of or factors affecting the primary market in general. Now, when we have primary market, we must be having a secondary market. Primary market, when the company issues securities for the first time and the investor purchases it, those are called as the primary issues, or the place where it is done. That means the whole of the economy, because today, nowadays, we can go online and purchase it, procure it. Now, after procuring it, shall we hold it, or in times of our need, or in times of higher share prices in the market, we should sell it? The answer in most of the cases is, let us sell it when the prices are high. Thereby we can lock in more amount of profit. So this buying and selling of the existing securities in the hands of the investor, the place is called as secondary market. It is usually the stock exchanges. In India, when we talk of stock exchange, we say Bombay Stock Exchange, BSE. Earlier, most of the stock exchanges were operating on a physical basis, but nowadays the stock exchange has gone online. That means they are offering platforms where you can transact in the equity shares in the electronic mode. So the secondary market should be available along with the primary market for a healthy economy. So as we just now discussed, economic requirement of funds. Investor today they are having surplus, so they are investing. We do not know what is there in our future. There may be need of funds at a certain point of time in the future years. So there, what we can do? We can sell our securities that we are holding in the secondary market, fulfill our requirement of funds. Another factor that is affecting the primary market is investors' risk return appetite. Most investor, we can categorize investor into, suppose, risk takers, risk avoiders, and risk neutral. Now, who are risk takers? Now, even though the company is not performing well, or a very new company without any kind of information or into a new venture, the return we are not assured of. So, there we call it as the high risk category. Now, what are the low risk category? Already a company is existing, or a new company whose promoters are having a track record of setting up and running successful businesses. So there we are assured of our return on money or return on investment. So there we are trying to not take enough risk. We are safeguarding ourselves. We are looking at more assurance. So this appetite for risk and return also affects the primary market. Similarly, performance of new issues. Now, many new issues come into the market. In that case, investor try to see what is happening in the marketplace. Is the economy growing? If it is growing, yes, the companies will be needing higher amount of capital so as to fulfill their needs for expansion, modernization, etc., to meet the excess demands. So, in that case, if the economy is working in a reverse way, that means economy is taking a downturn, then people will be swaying away from the equity shares. They will be moving into debt funds. So, performance of new issues affect the primary market. Now, the first or the most important source of capital for an organization is equity capital. We say equity capital is nothing but owner's capital. They represent ownership of the company. Why owners? Let us think ourselves. Suppose we have a household setup. Father is there. We are also staying in the house. So, in the house, whatever good or bad happens, we take it by ourselves. We stand by our house. We do not try to let it down. So, in times of need or difficulties, also we stand by our house. Similarly, organizations, the better times we call it as profitable times, or the difficult times we call as losses or loss periods. So, in both the situations, the shareholders, equity shareholders, stay by the company, stand by the company. They do not try to let down the company. So, they are called as the real owners of the company. Shareholders take the risk in the sense that, yes, our company may suffer losses today, but through particular decisions for the future, the company can again bring back its happier times. So, shareholders take the risk. If a plan fails, then losses may be suffered and it is affecting the equity shareholders. They also manage the company. In what way? The equity shareholders usually have the voting rights. Voting rights for what? That they can elect the board of directors who run the company. Owners do not run the company. It is the board of directors who run the company. So, equity shareholder try to keep the best persons in the board of director so that they can lead the company to better and better prospect future years. So, in other sense, we say the equity capital holders or the shareholders, equity shareholders manage the company through board of director. Now, what portion of the total capital of the company is made up by equity capital? First of all, when we are having a new company, in our memorandum of association MOA, we try to set up what is the authorized capital. Now, this authorized capital is this much capital you can raise from the market. Usually, the company do not go for the full authorized capital to be raised. They try to raise a portion at a point of time, again another portion at another point of time according to requirements. So they try to utilize the authorized capital allocated to them in certain proportions. Now, suppose out of 100 rupees that can be raised through equity capital, that means the authorized capital is rupees 100. Suppose the company board of director decide to issue 40 rupees of equity capital or 40% as equity capital. So out of authorized capital, we try to find out how much we shall issue in the market or float in the market. That is called as issued capital. Now for that, the process is usually, as we shall be learning as we move on, the clearance for the prospectus from SEBI, Securities and Exchange Board of India. What is the prospectus? Now it is the document which will be containing the company's details, the future plans, how it intends to look ahead in the future, near as well as far off, etc. So that prospectus should be cleared by SEBI, the regulatory authority in India. Then we have underwriters. What is underwriting? A certain institute, financial institute, which we shall be calling as merchant banker, they will take the task of, suppose our received capital in the previous example we were talking about was 40%. Suppose 40 equity shares we are floating. Then according to the regulation, a certain percentage of issued capital should be taken up by the general public so that the issue is successful. Suppose let us consider as 96. Sorry, 90%. So 90% means out of 40, 90% should be taken up by the public. So we are issuing 40% or 40 equity shares in the market. Out of that, 36 shares should be taken up or purchased by the investors in the market. Now suppose the number of shares that has been purchased comes down to 30. So we are not meeting the regulation. So our issue is a failure one. In that case, what we shall do? We have no option, but underwriter will come forward. It will take up the remaining 6 shares or purchase the remaining 6 shares and provide the guarantee that the issue is a successful one. For that, they charge a commission. Then bankers, the amount generated should be transmitted through a particular designated bank. Then registrars. Who are registrars? Now filing prospectus with registrar of companies, but before that, registrar should keep the details of the equity shares issued to various investors. Now equity capital, these are the type of equity capital we can have. Usually we have equity shares. Along with that, we have preference shares, which we say are the similar thing just like equity share except some difference. In equity shares, we can have bonus shares. That means out of the existing profits, we issue fresh issues or fresh equity shares to the existing shareholders out free of cost. Similarly, rights issue. Now, when a particular issue is to be floated, first it is offered to the existing shareholder. The sense behind that is the existing shareholder, the ownership proportion that they have maintained earlier should also be maintained. Then we have sweet equities. What are they? Now, sometimes we find certain employee or a particular employee has worked very hard for the organization, brought lot of transformations, changes in the company, which is leading to overall growth of the company. So the board of director may issue equity shares free of cost to that particular employee, so that it will motivate all the employees in the organization to work for the betterment of the company. Another way is voting equity shares and non-voting. Equity shares usually have voting rights. What do they vote for? Now they vote for electing the board of directors. Similarly, we have non-voting shares. It is usually not found, but when you are having non-voting equity shares, they do not have the right to select or elect the board of directors of the company. Similarly, we can have dividend equity shares and growth equity shares. Now, what is dividend? Out of each year's profit, if it is there, we cannot say whether it is profit or losses. If profit is there, and after paying the interest to the loan holders, that means debt capital and the preference shareholder, whatever the amount of profit that is left over, it belongs to the equity shareholders. That will be distributed in a proportionate manner as dividends. So dividends are the leftover profits after making all kind of payments for various capital sources distributed among common equity shareholders. Now, this distribution either it can be paid immediately or the company may hold it back. When it holds it back, it becomes retained earnings. Why the company holds it back? Now, to meet the future requirements of funds from this internal source. So, when it is retained earnings, we say growth equity shares. That means the dividend is not distributed to them, but their dividends are kept for future expansion, so that their future income it increases to a vast proportion. Next, we have preference shares. Now, cumulative preference shares and non-cumulative preference shares. Now, when distribution of profit goes on, usually we say if there is profit of the company, first it is paid to the debt holders. Even if it is loss, we have to pay the debt holders. So after taking care of debt holders or the loan funds, whatever profit is left over, that will be distributed among the preference shareholder and equity shareholder. The name itself, preference shareholder, that means they are given a priority on the profits as compared to the equity shareholder. That means they will take the profit amount first. Whatever is left after that, it will be given to equity shareholders. So when we say cumulative, and the profit, if it is unpaid in a given year, that will cumulate to the next years. And if it is non-cumulative, each year profit, if it is unpaid, then it will not be paid in the future years. Second is participating and non-participating. Now what happens? Preference shareholders, after getting their dividends, they also try sometimes to take a chunk of the equity shareholders' proportion of profits. That means they participate in also the leftover for the equity shareholder after getting their own payments. If they do not participate, that becomes non-participating. We also have the convertible preference shares. That means after a certain period of time, these preference shares will be converted into, we can say, equity shares. And if it is not having that kind of option, then it becomes non-convertible. Redeemable and non-redeemable. Suppose a preference share, usually they also have a lifespan as long as the company. But if there is a certain clause that the principal amount or the amount will be returned back to the preference shareholders after a certain period of time, then we call it as redeemable preference shares. Otherwise, it is a non-redeemable preference share. What are the advantages? No repayment is required for equity capital, because once the equity capital comes to the organization, it stays with the organization till the organization is going on. And we say life of an organization is infinite, unless until it is wound up or wind up. That means it is sold off according to the rules of the land, liquidation. And from the company's point of view, it is a low risk capital. Why? Because they do not have the obligation to pay profits each year. And here, investors can be treated as equity partners. What are the disadvantages? Now, it leads to dilution of ownership. More and more number of equity shares will lead to higher number of shareholders who are having voting rights, or in other words, the ownership rights. And raising the equity capital is having a high expense, because the company has to go through lot of process, lot of regulations to be adhered to, and various kind of advertisement, etc., so as to tap the investor. And it requires huge time and effort. The challenges in front market scenario, whether the market is in boom, better it is we can raise the equity capital. If the market is in downturn, then we say equity capital may not have that much takers. Investor sentiments also, regulatory constraints, and companies' futures. The second type of capital that we shall be seeing is debt capital. It is nothing but the loans or the borrowings of a company. Either it is loans or investment in loan format from others which can be institutes or investor also. It has a fixed repayment schedule. That means at every time period, certain time period, you have to pay a certain amount as interest, even if profit is there or not there. It is also called as coupon rate. It offers financial leverage and tax benefits. That means when we are using debt capital in our total requirement of funds, that leads to sometimes higher income for or leftover for equity shareholder, because debt capital take uh, out of the earnings a fixed percentage. So in times of higher earnings, they will take only their fixed percentage, and the higher retention amount is distributed or kept back by the company in the organization. And this debt capital provides tax benefits to the company. So the forms of debt capital can be loans, bonds, line of credit. That means if you go to a bank looking at your business or operations, the bank may offer you a amount in form of loans which will be kept ready always for you. So at the times of need, you can tap that fund and take it. Then we have equipment financing. The financial institutes many a times also come forward to finance the various machineries, equipments to the company. We have commercial papers as well as debentures. Now, in debt capital, what are the advantages? We have predictable cash flows. Tax benefit is available to the company. We have unrestricted funds, but more amount of debt capital may lead to a apprehension in the mind of the equity shareholder or owners of the company. Leverage, because they only take a fixed amount. In times of higher profit, the earnings of the equity shareholder will be higher, proportionately higher. What are the disadvantages? In times of losses, the company may face default risk. That means not able to pay the interest as well as the principal repayment. In those time, company has legal power to go to the court of law for liquidation of the company. That means sale of the assets or belongings of the company, and whatever is generated they will take up first. What are the challenges? Na convertibility, maturity, security, state of income. Now, when we compare equity versus debt market, the two major sources, fundraising. In equity share, we saw we have to tap the market, we have to generate a feeling of what we can say, feeling of increased demand in the minds of the investors, etc. It is very high cost and as well as time taking. Similarly, in debt market, we say fundraising is easy. We can tap a financial institute for taking loans, which will be of lower cost and very low time. The investor status, they are big financial institutes. The risk factor from a company's angle, equity shares do not provide high amount of risk, but debt capital will be providing high amount of risk. Regulators, usually in equity market, the regulators, they have a keen eye so that fraudulent practices do not take place. Talking of raising equity capital in international markets, all of us know that at this present era, the world is becoming a single economic unit. That means trade barriers are being uprooted. Free trade zone or free trade agreements are there between most of the countries. One can operate from its homeland and can choose the marketplace all over the world. So, in that case, we require a international capital market for what? To meet the foreign currency needs. Since we will be operating in foreign lands, their currencies will be needed to reduce overall cost of capital of the company. In some countries, the cost of capital may be low. In some countries, the cost of capital will be very high. Now, when capitals from the international market are flowing in, there the organization have to be of world class. In other words, they have to increase their productivity. Now, what are the things that usually are available in international capital markets? First is Global Depository Receipts, GDRs. So these are equity instruments issued by authorized overseas corporate bodies against shares and bonds of Indian companies. Suppose an Indian company wants to issue its shares to the public of European nation. So what it will do? It will appoint a overseas corporate body, OCB, authorized by the company, and with it they will keep the shares or the bonds, that means equities or debts, the Indian company will keep with the OCBs, and OCB will float the equity instruments. Now, these equity shares which are issued by Indian company, they will be kept with the designated domestic, that means the foreign country's domestic custodian bank. In lieu of that deposit, GDRs or global depository receipts will be issued. So holder of GDRs can convert the receipt into equity shares at any time. The receipt, suppose I am in London, I am holding a GDR which is saying 10 equity shares of RIL, Reliance Industries Limited. So that receipt at any point of time I can submit it to the designated bank and take up the equity shares of Indian origin. So global depository receipts, you can go to any place except in American depository receipts, or in America we have American depository receipts. Here the instruments are denominated in US dollars. Suppose an Indian company wants to be listed in US stock exchange, so it will deposit its shares with a designated bank in the United States. Now, designated bank will give a receipt to the Indian company, which will help the company to issue ADRs or American Depository Shares also. Same thing. So ADS are share certificates which represent the ownership of the deposited shares. Similarly, suppose a foreign national or a foreign financial institute wants to tap the Indian market, they can do also the same thing through Indian depository receipts, IDRs. So foreign companies source capital by issuing IDR in Indian market. So these are usually denominated in rupee form. And here the domestic depository is the custodian of the securities and it has to be registered with the Securities and Exchange Board of India. Another one is foreign currency convertible bonds, FCCBs. So these foreign currency convertible bonds can be converted to either the equity shares after a specified period, or you can redeem it at the face value. The redemption period is usually 5 years. Similarly, we can tap big multinational financial institutes as requirements through external commercial borrowings, ECBs. Suppose Asian Development Bank we can have, International or World Bank we can have. So they have two type of routes. One is automatic route where we do not need any kind of approval to invest in a country. Another one is approval route. In India, in approval route, they require RBI or the government approval for investment. In recent trends, we are finding fast changes, low interest rates, monetary policy is easing up, mainly the introduction of AI and technological developments all are becoming the new trends in the primary market. So with this, we shall end up our session today. We'll be meeting again with some other discussion in the later sessions. Thank you.